What do you need to afford a home that costs $680,000 here in Canada? Is it 80 a year, 100 a year? Maybe it's multiple six figures, plus a perfect credit score with no debt. If you're early in the process and you're thinking about buying a home, this video is a crash course for you. I'll walk you through the things lenders are gonna look at, things like your income, your credit, your down payment, and the surprise costs at the end that not many people talk about. If you do find this video helpful, do me a favor and subscribe. The first thing I want to talk to you about is what lenders look at. They don't really care that much about your income. What they care more about is your debt. Lenders want to know how much of your total income goes towards paying your bills, and especially knowing how much of that goes towards housing. The way they check this is they're gonna run two different ratios. The first one is called GDS, which is gross debt service ratio, and this is just for housing. They're gonna look at basically what it costs for you to live, your monthly mortgage payment, your property tax monthly, your heat utility, and if you're buying and you're paying strata fees, they're gonna take 50% of those strata fees into account. That number has to stay under 39% of your gross monthly income. The next one is TDS, which is total debt service ratio, and you can think of this as housing plus any other debt that you've got. Car loans, student loans, lines of credit, credit card debt. That number has to stay under 44% of your total gross monthly income. The easiest way that I know how to remember these is GDS is basically asking you, can you afford the home? Whereas TDS is saying, well, can you afford the home and all the other stuff that you've got? As an example, let's take a household income of $120,000 a year. That's going to keep the math simple. If we divide that by 12, we've got $10,000 gross per month. Now, when we look at the TDS ratio, that is going to include all your monthly debt. Everything from your mortgage payment, your property tax, heat, strata, and then everything else. Your credit card, student loan, car loans, everything totaled up has to be under $4,400 a month if your monthly gross income is $10,000. Now, by connecting the dots, you can see just how much having a bit of extra debt like a car loan or a student loan is gonna hurt what you qualify for on a mortgage. The advice that you're given on keeping your other debts low is really important because it directly impacts how much real estate you and your family qualify for. The second thing I wanna share with you is a good rule of thumb. Typically, most people can afford a property that is 4 to 5 times their annual income. So if we're making $100,000 a year, that means that family can typically afford a home in the $400,000 to $500,000 range. But that's more of a starting point. The other variables that matter that are gonna make a difference is basically what other debts they carry. How many car loans do they carry? How much credit card debt do they carry? And do they have any student loans? And obviously the interest rate environment when they buy is gonna play a big role in the cost. The third thing I want to talk about is the stress test, because in Canada, lenders don't qualify you at the rate that you're offered on contract. They're legally obligated to stress test you at either the rate plus 2% or the benchmark rate, which is currently 5.25%, and they're obligated to go with whichever is higher. As much as this rule sucks, the rule is in place to protect you and the rest of Canadians to make sure that if rates do go up, you still have household income that can handle those increased payments. The cost for that protection under the stress test does come with a trade-off because the higher the test rate is, the less you're going to qualify for. So even if rates do go down, if the stress test rate stays high, you still need more income to buy the same house. And that is why qualifying is so much more than just the rate. It's more so to do with how much room your income has to deal with the stress test payment. The third thing we want to talk about is how lenders are going to verify your income. If you are self-employed, whether that's hourly or salary with a steady job, that's pretty straightforward. Lenders will usually want a job letter, your latest pay stubs, probably a T4 or a notice of assessment, just to confirm that your income is consistent. Now, if you are self-employed, this is gonna work a little bit differently. Traditionally, most lenders will look at least 2 years of your income and average out your income to figure out what you qualify for. This part can get a little bit tricky as there are other options. There are alternatives like stated income programs or bank statement lending that can work if you're not showing huge numbers on paper. That's where a mortgage broker comes in to help you. I can help figure out which path is going to give you the best shot at approval. Because every lender looks at things a little bit differently, this is why you get so many responses like, well, it depends, because the right strategy can make a huge difference for what you and your family get qualified for. The next thing I want to talk about is the importance of credit scores. In Canada, credit scores can range from 300 all the way up to 900. And in order to get the best rates and access to some of the top lenders, you want to aim for a minimum score of about 680. If your score happens to be lower than a 680, say between 6 to 679, some lenders are still going to work with you, but you'll face some tighter rules and probably higher premiums. If you're under the 600 credit score, that's where life starts to get a little bit tricky for you. You're probably looking at B lenders, and you're probably looking at much tighter regulations with higher rates. Again, easy way to remember this: if you do have good credit over 680, you're gonna have access to better deals with more options. But if your credit is poor, you're gonna have fewer lenders and you're gonna deal with higher cost. Okay, the next thing I want to talk about is the down payment. So on a home that's priced at $680,000, we use a tiered system here in Canada, which means you need at least 5% down on the first $500,000, which is 25 grand. On the remainder, which is $180,000, you would need 10% down, which is $18,000. So that means your minimum down payment on a $680,000 home is 43 grand. You do obviously have other options to put more down. So like 20% down would be $136,000. Putting 20% down not only avoids insurance, it also makes you eligible for a longer amortization period, which can help reduce your monthly payments to free up some cash flow. Obviously, not everyone has access to throw 20% down at a purchase. But if you do have the money, if you can be gifted the money, what that means is you'll have a smaller monthly payment and you'll typically pay less interest over time. Everyone seems to think that the down payment exclusively comes from people's savings, and they obviously do come from savings, but they can also come from RRSP withdrawals through the home buyer's plan. They can come through TFSA, FHSA, or they can come from gifts from family. And if you're lucky enough to be gifted even partial down payment money or the whole down payment from family, say your parents, that's great. You just want to make sure that the money is in your account early and it's well documented. Now, most people are so hyper-focused on the down payment that they lose sight of the closing costs. This is typically not talked about enough, but when you buy a home, the down payment is not the only upfront cost that you need. You also need to budget for closing, which is legal fees, title insurance, property transfer tax, appraisal, and home inspection. A great rule of thumb is 1.5% for the purchase price put aside, ready to pay up front. A good reminder here, lenders do not pay for this. It is not rolled into your mortgage, so make sure before you start looking that you can account for that money to be paid up front. You've also got other fees that just creep up, things like moving costs, cost of furniture, utility hookups. All these little things tend to add up. So these fees can easily add up to $10,000 or more in this case, especially on a home priced at $680,000. So it's best that you don't spend every dollar on the down payment. Keep some cash on hand for when you get to closing. The next one I want to talk about is the other debt that you're carrying. If you are carrying a lot of other debt, this is going to affect your affordability and what you qualify for in a big way. We covered earlier that the lender is going to let you spend a total of 44% of your monthly gross income on all your debt payments. And on that previous example, our monthly gross income was $10,000. Now, let's say you already are carrying a $500 a month car payment and maybe a $300 credit card payment. That's an additional $800 a month in non-housing, non-mortgage debt. So now we have to subtract $800 from that $4,400, which was your total debt limit, to get $3,600 left over for your mortgage, taxes, heat, and 50% of your strata. That's $800 in non-mortgage debt that just reduced your mortgage budget by up to 20%. So now we have to take that total debt limit, which was $4,400 from your total debt service ratio, and we need to subtract $800, which is your existing non-mortgage debt. That leaves us with $3,600 for mortgage, taxes, heat, and 50% of our strata. That's $800 in non-mortgage debt that just reduced your monthly budget, your monthly mortgage budget, by almost 20%. In other words, instead of being approved on 44% of your monthly gross income, you're now only being approved based on 36% of that income. And that ultimately means you're going to qualify for a smaller mortgage. But let me show you how this plays out in a real life scenario. Let's take a look at what income you need. If we break it down, we're looking at a $680,000 home. We need 43 grand for the down payment. 5% from 500 is 25 grand. 10% off 180,000 is 18 to get the total of 43 grand. We're going to use current, a 3-year fixed rate, which is about 4.24%. And the stress test that is used here is either 5.25%, which is Canada's minimum qualifying rate, or 2% above the contract rate, whichever one is higher. So in this case, unfortunately, we need to qualify at 6.24%. And that is what our calculator is basing the required income on. We're gonna go with the 25-year amortization. We're also gonna account for property tax, $250 a month, which really is about 0.5 to 1% of the home price. Heat utility at $100 per month. Then we have other debt, which was $800 a month, which was $500 in car and then $3 in credit card. And with those numbers, we would need an income of about $145,000 a year to qualify. So if we bump that debt up $1,000 to $1,800 a month, maybe you've got another truck loan, that new income required is $173,000, which is almost a $30,000 swing just from the monthly debt that you carry. So if home ownership is a priority for you, keep your debt low while qualifying. Ultimately, guys, lenders are looking to provide secure loans to people that have stable income, healthy credit, low or reasonable debt levels, and enough down payment so you've got skin in the game. If you've got those right, you're already ahead of most buyers. If you guys want to see what your numbers look like, send me a message. I'd love to help.